In 2010, Greece defaulted on its debt and nearly took the Eurozone with it. But the real shock wasn't just a collapse. It was how quickly the panic spread. Banks in France, pension funds in Germany, even markets in Asia felt the tremors. That's because modern sovereign debt isn't isolated. It's a tightly wound network of obligations, rolled over indefinitely, held by nations, central banks, and private investors who are themselves borrowers elsewhere. This is a global financial paradox.
The dollar is falling. The empire is fading. But your voice is rising. Don't just watch history happen. Be part of it. Why'd have you checkmark subscribe to this channel for more fearless analysis from Richard Wolff and voices the mainstream media refuses to platform?
Everyone is in debt, but no one seems to be the ultimate lender. The illusion of solvency is maintained not through repayment, but through relentless refinancing. Debt feeding on debt in a fragile system that depends entirely on trust. When confidence breaks, the structure doesn't bend. It snaps. That system, built for perpetual motion, has become the silent engine of global finance. Governments issue bonds not to settle accounts, but to postpone them. Central banks inject liquidity, not to create value, but to preserve the illusion of stability. Trillions circulate in a loop, enriching asset owners while taxpayers fund the interest. And all of it rests on a single assumption, that the music will never stop. But if it does, if belief in sovereign repayment wavers, the fallout won't just be economic. It will be systemic, social, and global. Every country is in debt, trillions upon trillions owed. Yet when you stop and ask the simplest question, owed to whom? You hit a wall of confusion. Governments, banks, institutions, central banks, even other nations, all lending and borrowing at the same time, in a financial Ouroboros where creditor and debtor are often one and the same. This is a paradox at the heart of the global economy, a world drowning in debt, yet no single entity standing at the top holding the bill. The global debt load is over $315 trillion. That's more than 3 times the size of the entire world's GDP. And still growing. But there's no singular banker in the sky keeping track. Instead, what exists is an elaborate, self-sustaining loop. Countries borrow from each other. Banks buy government bonds. Central banks buy those bonds from the banks. Institutions hold debt on balance sheets that are financed by other debt instruments. It's a closed circuit of obligation, backed not by gold or hard assets, but by belief. The belief that the system will keep working. This isn't a glitch. It's the design. Sovereign debt was never intended to be paid off. From the beginning, its purpose was a repayment. It was rollover. Reissue old debt with new bonds. Keep the interest flowing. Kick the repayment date further down the road. Again and again. The entire architecture of global finance is built on the expectation that governments will not pay their debts in full, but that they'll keep paying interest forever. This all started centuries ago. In the 17th century, England created the first real government bond system to finance war. It wasn't backed by gold or land. It was backed by the promise of future tax revenue. That's the model that stuck. Governments could now spend more than they had. And so began the era of perpetual debt. It exploded in the 20th century. 2 world wars, the Great Depression, Reconstruction, Cold War defense spending. Governments borrowed heavily to survive and to rebuild. But it wasn't until 1971 that everything changed fundamentally. That year, the U.S. broke the dollar's link to gold. The Nixon shock severed the final connection between money and physical value. What followed was a rise of fiat currency, money backed by nothing but trust in governments. With that move, borrowing had no hard ceiling. There was no longer a finite supply of money. There was only supply limited by confidence. That confidence is now the single most important commodity in the global economy. If investors believe a government can service its debt, they keep buying bonds. If that belief falters, even slightly, everything can collapse. This is why interest rates, credit ratings, and bond markets have so much power. They don't just reflect reality. They create it. A downgrade from a credit agency can trigger a cascade of bond sell-offs. Rising interest rates can turn manageable debt into a crisis overnight. This system is fast, volatile, and fragile. Most people believe governments take on debt for emergencies or big projects. And yes, sometimes that's true. But more often, debt is used to paper over gaps, budget deficits, political gridlock, short-term demands. Debt becomes a permanent feature, not a temporary fix. And since full repayment would implode the system, rollover is the goal. This model works. Until it doesn't. When it fails, the fallout is brutal. Greece in 2010 is a textbook case. A relatively small economy defaulted, and the shockwaves rattled the entire Eurozone. Banks that held Greek debt were exposed. Other vulnerable nations were suddenly seen as risky. A doom loop emerged where weak economies and struggling banks reinforced each other's decline. It was a warning. No country exists in isolation anymore. Global debt is interconnected. When one link breaks, pressure builds elsewhere. If one government defaults, it challenges the belief that debt is safe. And once belief is shaken, the system begins to crack. This is why confidence must be preserved at all costs, even if it means printing money, manipulating rates, or bailing out financial institutions. The biggest player in this entire setup is the United States and its central bank. The U.S. borrows more than any other nation, but it also issues the world's reserve currency. That gives it enormous power and enormous responsibility. Through mechanisms like quantitative easing, the Federal Reserve can create money out of thin air and use it to buy U.S. government bonds. That supports demand, keeps interest rates low, and reassures markets. But it also pushes the system further into artificial territory, where debt is backed by more debt, supported by newly created money. This isn't conspiracy, it's monetary policy. And it works for now. But it's also built on the assumption that inflation can be controlled, that trust remains intact, and that future growth can cover the borrowing. Those assumptions are now under pressure. What's often overlooked in this discussion is who really benefits. While nations, banks, and institutions swap debt around, the winners are the asset holders. Pension funds, wealthy investors, and large institutions receive steady interest payments, underwritten by taxpayers. That's the engine of wealth transfer. Ordinary people pay taxes. Governments use those taxes to pay interest. The interest flows to bondholders. Over time, this entrenches inequality. The wealth gap widens not just because of wages or jobs, but because of how debt is structured. If you own the debt, you collect. If you don't, you fund it. That's the quiet redistribution baked into the global financial system. And what happens if the debt keeps growing unchecked? Debt traps. A nation takes on debt to pay off old debt, then takes more to cover the new interest. Eventually, more money goes to servicing debt than to public services, infrastructure, or growth. At that point, the debt itself becomes the economy. That's the trap many nations are now approaching. Interest payments as a percentage of GDP are rising fast. Some countries are already spending more on debt servicing than on education or defense. That's not a policy failure. It's a systemic consequence. The challenge now is one of balance. The world runs on debt. Cut it too fast, and you trigger collapse. Let it grow unchecked, and you trigger collapse. The system requires constant, careful calibration. Enough borrowing to keep the economy moving, but not so much that trust breaks. That's a tightrope walk with no net below. All of this leads to the uncomfortable truth. The global financial system isn't designed to end. There's no final payment, no zeroing out. It's designed to roll over endlessly, because that's what keeps the wheels turning. Stop the rollover, and you stop everything. That doesn't make the system evil, but it does make it dangerous. It's not built for resilience. It's built for momentum. It works as long as people believe it will. The second they don't, markets panic, credit dries up, currencies tank, and defaults begin. What we're left with is a fragile global economy, held together by promises, contracts, and psychology. And the people managing it, the politicians, central bankers, and finance ministers, are trying to steer it through inflation, inequality, geopolitical shocks, and rising interest rates all at once. If they succeed, the system lives on. If they fail, the crash won't just be financial, it'll be structural. And the fallout won't stay in the markets. It will hit households, jobs, savings, and the stability of entire nations. This is the high-stakes game every country is now playing. Perpetual debt to maintain perpetual motion. The question isn't how we pay it off. That's not the plan. The real question is, how long can this last before something gives? If this helped you understand what's really behind the global debt system, then don't let it stop here. Share this, like it, add your thoughts in the comments below, and hit that subscribe button if you want more breakdowns that cut through the noise and tell the truth. The world deserves clarity, not confusion, and it starts right here. The most dangerous part of the global debt system isn't the size. It's the illusion of permanence. Everyone has come to accept the system as untouchable, too big to fail, too complicated to question, too embedded to ever unwind. But nothing is permanent, and when a system is this tightly wound, this dependent on faith, and this leveraged on perpetual motion, it doesn't need a massive event to unravel. It just needs a crack. That crack could come from anywhere. A bond market panic, a political default, a surprise downgrade, a sudden drop in demand for a major country's debt. And when it starts, the collapse is contagious, because this is a linked system. When one major player stumbles, the others lose balance. Greece was a warning. Argentina, Turkey, Italy, Sri Lanka. Every crisis sends tremors through the global web. The longer we pretend that these are isolated events, the closer we move to a rupture no one can contain. This system has been built for velocity, not strength. It's a machine fueled by trust and momentum, not stability. Central banks print money to stabilize it. Politicians stretch fiscal rules to hold it together. Institutions hedge their risk. But the truth is, no one is safe if trust evaporates. There is no firewall when everything is connected. And yet, the average person has no idea how this works, because it's been deliberately hidden in plain sight. Talk of public debt is usually drowned in technical jargon. Bond yields, quantitative easing, primary deficits, all terms designed to cloud the issue. But when you strip it down, here's what it really is. Governments borrow from rich investors and institutions. They pay those investors interest using taxpayer money. The investors make a profit. The public foots the bill. If that sounds backwards, that's because it is. The system was never designed to be fair. It was designed to be functional for those who benefit from it. And as long as trust holds, it functions. But what it creates is a permanent cycle where the money flows upward. Interest payments go to the wealthy. Tax burdens fall on the working and middle class. It's not a conspiracy. It's arithmetic. And yet, we're told debt is essential. That borrowing fuels investment. That deficit spending is necessary for growth. That rolling over debt is normal. In the short term, that's true. But the long term is another story. The longer we rely on this architecture, the more we surrender our control to forces outside democracy, markets, central banks, unelected agencies. And the more governments prioritize bondholder confidence over public welfare, the more distorted our priorities become. Public services get cut, not because there's no money, but because interest payments come first. Infrastructure gets postponed, not because it's unaffordable, but because servicing the debt takes precedence. In this framework, growth must happen, but only on terms that protect the debt cycle. It's not about what benefits society. It's about what reassures markets. And this cycle locks governments into obedience. They can't afford to spook bond markets. They can't risk inflation. They can't raise spending without raising yields. Even central banks, supposedly independent, operate within the parameters of market satisfaction, because once confidence breaks, interest rates spike and the whole edifice starts to tremble. The most powerful players in this system, the U.S. government and Federal Reserve, have tools no one else does. The U.S. can print the world's reserve currency. It can buy its own debt with money it creates. That gives the U.S. unmatched leverage. But it also increases global dependency on U.S. monetary policy. When the Fed tightens, the world feels it. When it eases, the system floats a little longer. But there's always a cost: asset bubbles, currency devaluation, inflationary pressure. Other countries don't have that luxury. When they borrow, they're at the mercy of lenders. If rates rise globally, they have to pay more just to roll over their debt. Some can't keep up. That's where the defaults start. And that's where the global ripple effect becomes a tidal wave. We've seen the cycle before. The Latin American debt crisis in the 80s, the Asian financial crisis in the 90s, the Eurozone crisis in the 2010s. Each time debt was a match. Each time it was confidence that failed. And each time the public bore the consequences through austerity, unemployment, inflation, and political upheaval. And we're heading there again. Why? Because the system hasn't changed. It's only grown more complex, more fragile, and more unequal. The total debt keeps rising. The interest payments keep increasing. The wealthy keep earning returns. And the public keeps paying the price. The promise was that debt would fuel prosperity. That borrowing would create jobs, fund infrastructure, and lift living standards. But the reality is that much of that money circulates within the financial sector, use it buy back stock, inflate assets, or service old obligations. What we have is a cycle where the financial system feeds itself, with real economic growth taking a backseat. And when growth does happen, it's often uneven. Asset owners benefit. Ordinary workers fall behind. The wealth gap widens because the benefits of the debt system accrue to those who own the assets, government bonds, corporate debt, real estate, all subsidized by artificially low interest rates and constant central bank intervention. The irony is that the very system that claims to promote stability is the same one that generates instability, because it magnifies shocks. It creates incentives for risky behavior, knowing that central banks will intervene. It punishes governments that challenge its logic, and it traps nations in a cycle they can't escape without collapse. Sovereign debt is no longer a tool. It's a cage. And the longer we deny that, the more dangerous it becomes. There is no easy way out. Default? Catastrophic. Repayment? Impossible. Austerity? Politically suicidal. The only viable path is reform. But reform means confronting entrenched interests. It means redefining the role of debt. It means rebalancing power between public need and private profit. And that's a fight no government wants to pick. But they'll have to, because the longer we postpone it, the more violent the correction will be. The global debt system, as it exists now, is unsustainable. It demands constant growth in a world with finite resources. It demands perpetual borrowing in a world facing political and environmental uncertainty. It demands faith when trust is breaking down. If there's one truth that can't be ignored, it's this. Debt is no longer about investment. It's about survival. And when survival depends on rolling over liabilities indefinitely, the system is not secure, it's desperate. The coming decades will test whether this fragile system can adapt, or whether it snaps under the weight of its contradictions. The stakes are enormous. Economic collapse, mass unemployment, political chaos, social unrest. These aren't hypotheticals. They are historical precedents. This is why understanding the debt system matters. Because it's not just abstract numbers. It's about who controls the economy, who benefits from the system, and who pays for it when it breaks. The lenders? They're not hidden in the shadows. They're in plain sight. Central banks, financial institutions, pension funds, foreign governments. They are the beneficiaries of a system that was built to ensure their position. The borrowers? That's every government on earth. And the people paying the interest? That's us. The most disturbing part of this entire system is how normalized it has become. We've accepted a world where debt is a default, where balanced budgets are punchlines, and where no one, not governments, not institutions, not even central banks, has any intention of repaying what they owe. The only goal now is to service interest and keep the illusion of solvency alive. That's the trick. As long as everyone keeps pretending the system is stable, it stays stable. Until it doesn't. This is not theoretical. It's already being tested. Look around. Interest rates are rising globally. That means the cost of rolling over debt is rising with it. Governments that borrowed heavily during the low-rate era of the 2010s are now waking up to the brutal math of the 2020s. Suddenly, those interest payments, once manageable, are eating up entire budgets. Social services are being cut. Infrastructure projects shelved. Healthcare systems stretched to breaking. Why? Not because governments ran out of money, but because servicing the debt has become the priority. This is where the lie gets exposed. Politicians love to say, "We don't have the money for that." But what they really mean is, "We've committed so much to the bond markets. There's nothing left for you." That's a silent reordering of priorities that the debt system enforces. It's not elected governments making budget decisions based on need. It's elected governments making budget decisions based on appeasing creditors. And here's the hard truth. The wealthiest people on earth are the ones holding the debt. Institutional investors, pension funds, sovereign wealth funds. They own the bonds. They collect the interest. They benefit when rates rise and when governments scramble to meet their obligations. It's a machine that extracts wealth from the taxpayer and deposits it in the hands of asset owners. And yet, it's invisible to most people because it's buried in spreadsheets, in budget line items, in quarterly reports. The transfer of wealth from the bottom to the top doesn't happen through theft or corruption. It happens through interest payments. Quiet, legal, constant. This is why inequality keeps rising, no matter how much governments talk about addressing it. Because the system is structurally designed to reward capital and punish labor, to feed asset growth while suppressing wages, to subsidize wealth accumulation at the top, while telling the rest to tighten their belts. Even central banks, those supposedly neutral guardians of economic stability, are complicit when they engage in quantitative easing. They create money to buy government debt. That props up bond markets. It keeps rates low. But it also inflates asset prices, stocks, housing, corporate debt, while doing little to directly help working people. Trillions are created and deployed, not to reduce inequality or invest in public goods, but to sustain financial markets and protect the status quo. The result? A world where growth is increasingly financial, not productive, where speculation is rewarded more than innovation, where economic health is measured by the stock market, not by living standards, where a handful of institutions hold more power than entire democratically elected governments. And when things go wrong, the same playbook gets rolled out every time. Bailouts, austerity, stimulus at the top, belt tightening for the bottom. It's a system that privatizes the gains and socializes the losses, then blames the public for wanting too much. But here's the most important point of all. This system is not permanent. It can break. And when it does, it won't be polite. It won't come with a warning. It'll be fast, chaotic, and brutal, just like 2008, just like the Eurozone crisis, just like every default and collapse before it. Because when confidence goes, it goes all at once. And everything that looked safe suddenly looks toxic. Markets freeze. Credit evaporates. Currencies crash. Unemployment spikes. And governments, so used to borrowing their way out of trouble, find they've lost control, not just of the economy, but of the public, because people don't stay passive forever. They revolt, politically, socially, economically. They lose faith, not just in the system, but in the very idea of governance. We're not there yet, but we're closer than anyone wants to admit. The signs are clear. Rising interest burdens, record-high debt-to-GDP ratios, falling confidence in institutions, global tensions over currency and trade. Every pressure point is being tested. And still, the system moves forward, hoping that momentum alone will carry it through. But momentum isn't a strategy. It's a delay. If governments want to avoid catastrophe, they need to rethink the fundamentals, not just tweak the numbers, but challenge the assumptions. What is debt for? Who does it serve? Who bears the cost? Can a system built on endless borrowing survive in a world of finite patience? Because right now, we're living in a house of cards. Beautiful from a distance, fragile up close. And the higher it gets, the harder it falls. If this breakdown has helped you understand how deep this system runs and how much is at stake, don't let it end here. Like this video. Share it. Comment with your perspective. Subscribe so you don't miss what's coming next. The truth matters. And the more people who understand it, the harder it becomes to ignore. Let's pull back the curtain and keep it open